Tim, I think it's important to note you were at the Treasury back in 2011, the last time that we reached this brink of a possible default. We did reach a deal. How does this look compared to that time?
Well, it looks like a lot of conversations in Washington, particularly when you have divided government. There'll have to be negotiation, and the negotiation is likely going to take a lot longer than the market would like and a lot longer than most people are indicating. As the president and the speaker indicated over the weekend, they aren't close. They're not close on the issues that they'd like to discuss. They're not close on the issues that are required to be settled in order to come to a long-term accommodation of Treasury's ability to borrow. I continue to believe that we're set for a couple of short-term actions, probably one this week, if not next week, that gets us through the end of June, and then likely another short-term action, a suspension of the debt ceiling, so that negotiations can first form and then be completed.
All right, so it sounds like you're in the consensus opinion, short-term extension, no default. We've heard the president and the House Speaker say that they both want to avoid a default. Back to 2011, I want to just pull on some of your experience when it comes to some of this. In 2011, we did reach a deal. There was no default, but the U.S. still saw its credit downgraded, by S&P. Do you see any risk of that happening again this time around? And how do you see the market impact if that happens?
Well, the downgrade, and Frank, I'm not sure, I think it might have been Moody's, but the downgrade occurred largely because of a misunderstanding of the appropriate baseline to use. Nonetheless, there was a process over the weekend, the last weekend of July, that allowed the board based in London to determine that there was enough risk to downgrade the U.S. That came and went. The real harm to the U.S. economy, to U.S. taxpayers, the erosion of confidence in the reserve currency government's ability to manage its books, and then two, the costs that are associated, as you pointed out, costs rising. They're mainly showing up in the 1 to 4 month bills, but that higher yield that's been paid over the last 3 or 4 weeks, the risk premium that's being demanded by the market, comes out of the taxpayer's pocket, and it's never discussed, it's never replenished. So there are costs, real costs, every day that we continue the uncertainty around debt ceiling.
Yeah, I mean, certainly there is a lot of uncertainty, and there's some real world costs, especially if we actually do default. I think a lot of real life people, forget about Wall Street for a second, would be hurt. I want to go back to these negotiations and what we're hearing. So just yesterday, Kevin McCarthy said there was a productive call between he and the White House. He also commended some of the professionalism of the negotiators. So hearing some mixed signals. How do you see the direction of these negotiations continuing from here? Are we on a linear path, or are there more ups and downs, bumps, maybe even backward steps?
All of those, Frank. It's very likely that this will be a nonlinear process, in part because the two sides haven't really joined the conversation. They really have only been talking to each other for a week. In 2011, 2013, in 1996, when we got very close to default, negotiations were months long before this was avoided. And so, yes, expect that, as both leaders know, President Biden, Speaker McCarthy know that with very narrow margins in Congress, they don't have a lot of room to wiggle. And they're hearing from factions within their party that make it very difficult to settle on what the agenda, the negotiation agenda might be, much less the outcome. And keep in mind, it's just been this weekend that the notion of default has hit mass media. Fairly soon, as Americans go or attempt to go to their first vacation, summer vacation, they're going to start paying attention to what's going on in Washington. And the question voters will ask is, why are you threatening to do something as dramatic as default when what you're fighting over, A, hasn't been defined, and B, isn't going to be that much? Let's keep in mind, Speaker McCarthy has taken revenues off the table, and at the President's State of the Union, both parties stood up nearly unanimously to applaud that there be no cuts to Medicare and Social Security. If you're not going to touch those three areas, you're really not arguing over much.